In this video, I'm going to discuss about standard costing and variance analysis. What is standard costing? Standard costing is a management accounting technique that involves setting predetermined standards. This is known as standard costs for various costs such as direct materials, direct labor and overhead. We discussed about standard costing, cost card under marginal costing and absorption costing. These standards represent the expected or target costs for producing a unit of product or delivering a service. Once the standards are established, the actual costs are compared to these standards in order to evaluate performance and identify areas for improvement. This is known as the variances. Any variances between the actual and standard costs are analyzed and reported to management for corrective action. These are the processes of feedback control system. We discussed about feedback control systems in an early video. Standard costing is an important tool in management accounting that helps managers to control costs, plan budgets and forecasts, evaluate performance, valuation of inventory, make pricing decisions and encourage continuous improvement. Standard costing should be updated or revised regularly to reflect the current market conditions and variations. These are the examples of standard costing cost cards for marginal costing and absorption costing. This is the absorption costing standard cost card and this is the marginal costing standard cost card. As you can see, all the variable and fixed production costs for a production unit are stated under the standard costing card. And then the markup for the production unit and the final selling price per unit is clearly indicates under standard cost card. These are the production costs under marginal costing cost card. As now you know, we do not consider fixed overhead for the marginal costing. So there is no fixed cost amount. And using the variable production cost, we can calculate the production cost per unit. Then we can add the markup and finally we can calculate the selling price per unit. These are the most common standard cost cards in businesses. Now let's discuss about different types of standards. Ideal or perfection standards. These standards are based on the assumption of perfect operating conditions and maximum efficiency. They represent the best possible level of performance that can be achieved under ideal conditions. Ideal standards are used to motivate employees to strive for continuous improvement. In reality, these standards are difficult to attain and will demotivate employees. Attainable or practical standards. These standards are based on actual operating conditions and take into account the limitations of equipment, materials, and labor available. Attainable standards are more realistic and achievable than ideal standards, and they provide a benchmark for evaluating performance. Basic standards or historic standards. These standards are established for a long period of time, often several years. They are used to provide a stable basis for planning and control. Basic standards are updated periodically to reflect changes in operating conditions and costs. Finally, the current standards. These standards are established for a short period of time, often a year or less. They are used to reflect current operating conditions and costs. Current standards are updated frequently to ensure that they remain relevant. Now that we know the standard costing, we can discuss about the variance analysis. This topic is really important in management accounting. You will be tested heavily on this topic in your exam. Variance analysis is a management accounting technique that involves comparing actual results with expected or budgeted results in order to identify differences or variances. So simply variance analysis is the comparison between the actual results and the budgeted results in an organization. The purpose of variance analysis is to identify the reasons for the variances and take corrective action if necessary. Under variance analysis, you have to calculate the variances as well as you have to have the understanding of what causes the variance. These two parts are really important in the variance analysis. There are two types of variances in variance analysis: favorable variances and unfavorable variances. Unfavorable variances are also known as adverse variances. A favorable variance occurs when the actual results are better than the expected results, such as when the actual cost is lower than the expected cost. You can understand if the actual cost is lower than the budgeted cost, it is favorable to the company because the company has spent less than the budgeted amount. An unfavorable or adverse variance occurs when the actual results are worse than the expected results, such as when the actual cost is higher than the expected cost. In this case, the company has spent more than the budgeted amount. This is an adverse variance to the company. We can divide the variance analysis into two groups. The first group is costs variances and the second variance group is sales variances. Under cost variances, we will discuss about how the cost variances are calculated and what are the reasons for the variances. And under sales variances, we have to calculate the sales variances and we have to identify what are the reasons for the variances. Under cost variances, we will discuss about material variance, labor variance, variable overhead variance and fixed overhead variance. Under sales variances, we will discuss about sales price variance and sales volume profit variance. In the next set of videos, we will discuss about each of these variances one by one because we have to calculate each variance separately and we have to have the understanding of the reasons for the each variance. Thank you for watching. See you in the next video.